Hi, and welcome to part 2 of the Social Security Maximization course, a Yields for You Retirement Readiness course. In today's video, we're going to review the first of 4 benefits provided under Social Security. We're going to be discussing the Retirement Income Benefit, the Spousal Benefit, and how they are calculated and common methods for maximizing your monthly Social Security check. For those of you who don't already know who I am, my name is Label Sternbach. As you have probably guessed, I am a financial advisor, and I specialize in helping people transition into and through retirement. I've spent the last 12 years personally working with independent retirement advisors across the country. I am a National Social Security Advisor certificate holder. I am an enrolled agent with the IRS, which means I am authorized to prepare tax returns and represent people before the IRS, like a CPA. I'm also an accredited portfolio management advisor from the College for Financial Planning and a chartered financial consultant with the College for Financial Services. Articles I've written have been featured on major media outlet websites, including Yahoo Finance. I also publish regular articles and videos on retirement planning and investment management, which can be found on our website at yieldsforyou.com. As I mentioned in our last video, this course is broken up into 3 parts. The first is the theoretical knowledge, which we're going to cover in these videos. The second is the maximization analysis, and the one-on-one strategy session, where we take the theoretical knowledge and maximization analysis and discuss how to best implement it in your life and your personal situation. Okay, let's get started. So how does our esteemed government calculate your retirement benefits? The short answer is that the Social Security Administration takes the salary for the top 35 years that you paid into Social Security and adjusts that number for inflation. So that $20,000 that you made in 1970, they adjust it upwards to today's equivalent dollars. For the years you didn't work, a 0 is used, and where you earned too little or too much, the numbers are adjusted as well. Once the government is done fiddling with your numbers, they then average it across 420 months, which is the 35 years, and adjust it some more, and that number becomes the basis for your primary insurance amount, or PIA. Your PIA is what all your benefits are based on. When you look at your Social Security statement, you're going to see a list of the benefits you're qualified for and the amounts you're eligible to receive. Of course, the government isn't done fiddling with your numbers just yet. The next adjustment that they do is for early versus delayed retirement credits. Basically, Congress decided that in order for us to get our full Social Security benefit, we would need to retire at our full retirement age, or FRA. Our FRA is a date determined by Congress and subject to revision. So at FRA, or full retirement age, you get your full PIA. The government loves their acronyms. If you decide to retire early, they will reduce your payment. Conversely, if you delay retirement, they will increase it. The amounts are not proportionate. However, for most people, basically you can increase or decrease your benefits by about 8% for each year you claim early or take it late. What is important to note is that the calculation is done on a monthly basis. So for each month you delay, you increase your benefits up until age 70. After age 70, the benefits will not increase. Also, early retirement benefits are a use it or lose it proposition. You cannot retroactively claim early retirement benefits. So you're going to want to evaluate if early retirement is right for you as soon as possible, right? So again, those early retirement benefits that you can claim from starting at age 62 until your full retirement age, if you don't claim them, you cannot claim them later. So each month that goes by, you are potentially missing out on money that you could have received. The chart on the screen demonstrates the hypothetical maximum reduction or increase one could see for retiring early versus delaying Social Security benefits. Of course, it isn't just your monthly benefit that is affected, but your lifetime benefits as well. Let's take a look at some examples. In this theoretical example, we have our lovely Todd and Marianne. We are going to say that Todd is going to live to age 85, and Marianne, being a woman, is probably going to outlive Todd and live until age 90. Based on their full retirement ages, if Todd were to claim early benefits, his monthly check would be reduced to 73% of his primary insurance amount, or it would be reduced by $533, which translates to $42,000 over the course of Todd's life, which isn't that much money when you consider it. However, if Todd were to have delayed retirement until age 70, his monthly check would have increased by $587, but his lifetime benefit would have increased by $170,000. The reason for the stark difference is not only because each month Todd is getting an extra $587. That's not enough to account for that difference. But as Social Security increases his payments for inflation, or as they call it, the cost of living adjustment, his benefit check increased not from the $2,000 amount, but from the $2,587 amount, which means by the time Todd turned 85, his check had increased to $4,500 a month. If Todd had retired early, his benefits would have only increased to $3,421, which is a significant difference from the $4,500, which is his maximal deferral. Of course, deferring for longer doesn't always mean your check will increase, or that the increase in lifetime benefits are necessarily worthwhile, right? If we look at Marianne's benefits, you can see that at full retirement age, she gets the greatest monthly check. However, she gets the greatest lifetime benefit by delaying retirement. So the question really becomes a question of cash flow and your income needs. What are your expenses in retirement? Will they increase or decrease? Where will you want to live? How will you spend your time? Will you be golfing, boating, sightseeing, on the beach? Will you travel more for pleasure, visiting family? These are questions you need to think about. The type of lifestyle you want to live will have a direct impact on your income needs and will help determine what has more value to you, a smaller check earlier in your life or a hypothetical greater lifetime value. Something that you also need to consider, how claiming early or late affects your survivorship benefits. We will address these questions and more in later videos. For now, let's talk about spousal benefits. As we mentioned in the last video, even if you didn't work, you may be entitled to benefits. Spouses are entitled to benefits under their spouse's work history. In order to qualify for spousal benefits, your spouse must be alive. You need to have been married for at least 1 year. Your spouse needs to have filed for Social Security benefits. And like retirement income benefits, the earliest you can claim benefits is at age 62. If you claim benefits at your full retirement age, your spousal benefit will be 50% of your spouse's primary insurance amount, which is usually their benefit if they claim benefits at full retirement age. Of course, nothing is ever simple. As part of the last round of changes made by Congress, one of the benefits they changed was how spousal benefits are calculated. Essentially, Congress reduced benefits without outright saying that they reduced benefits. Prior to this rule, a spouse was entitled to 50% spousal benefit as well as their own Social Security benefit. They can then choose to claim the spousal benefit while allowing their own benefit to grow. This was known as file and suspend. Now, due to the deemed filing rule, when you file for benefits, you are deemed to have filed for all the benefits you are entitled to. And you are only entitled to benefits if your spouse has already claimed their benefits. Let me repeat that. You're only entitled to spousal benefits if your spouse has already claimed their benefits, which has the net effect of reducing the total benefits one is entitled to. Of course, Congress wasn't quite done yet. In addition to the deemed filing rule, they also said that instead of being entitled to 100% of your spousal benefit, you will now only be entitled to the difference between your full retirement age benefit and your spousal benefit. What this means is that if you file for early retirement, when your spouse does eventually file for benefits, you will be entitled to a smaller increase in benefits than if you had waited until full retirement age. This is just another way that the government can reduce your benefits without outright saying that they're reducing your benefits. As the saying goes, figures don't lie, but liars like to figure. Okay, I know what you're thinking. That was a ton of information, Label, but I don't know what any of it means or how it relates to me. Don't worry, I got you covered. All that theoretical information that we just learned, let's take a look at how it plays out in real life. Everyone, I'd like you to meet our lovely volunteers for tonight's demonstration. Give a warm welcome to John and Debbie Homemaker. John is a manager at an engineering firm, and Debbie was a stay-at-home mom for their 3 kids. John is 64, and we're going to assume he is going to live to the ripe old age of 85. And John's Social Security benefit at full retirement age is $2,500. Debbie, being a woman, will probably live longer, let's say to age 90. And since she didn't work enough to qualify for Social Security on her own record, she is eligible, wait for it, ding 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 ding, you guessed it, a 50% spousal benefit under John's work history. So her benefit is $1,250 if and when John claims benefit at full retirement age. Okay, so let's see how our couple makes out. In door number 1, we have an early retirement. If John files at age 64, their monthly benefit is reduced and their lifetime benefit amount will be $1.3 million. Not too bad. However, let's peek behind door number 2. If John and Debbie delay benefits, they will have effectively increased their lifetime benefits to $1.64 million. Or in other words, by delaying their retirement, they will have increased their lifetime benefits by $355,000, which is a lot of money when you are retired and your ability to earn is seriously limited. But delaying isn't always the right answer. Let's take a look at another example. Same couple, but this time we're going to say that Debbie worked part-time and she's entitled to $1,000 a month in Social Security benefits for herself. When we run her benefit analysis, what we found is that in this case, Debbie should actually claim benefits at her full retirement age. Remember, before she claimed early, while John should actually delay retirement until age 70. In this scenario, there was little benefit to having Debbie delay her retirement. However, it was still worthwhile to have her wait until full retirement age. Of course, there are other factors that could reduce benefits that may affect your decision of whether you or your spouse should claim early benefits. In our next video, we're going to discuss survivor benefits, ex-spouse benefits, and the impact of divorce and remarriage on your benefits. And we're going to talk about how you can get a lump sum from Social Security, and we're going to discuss the do-over and the reset strategy. Remember, everything works together, right? You've got your income, you've got tax planning, you've got estate planning, you've got that continuity planning. All of these are factors that affect when and how you should take retirement, or your Social Security benefits. The question you really got to ask yourself is, what will your retirement look like? What will you spend your days doing? How much will that cost? How much money will you need? What type of health are you in? How long have your parents lived? How long have your spouse's parents lived? How long do you think realistically you're going to live? And do you think that you're going to be healthy for most of your life? Or do you have a history of disease and illness in your family in later age? These are questions you got to consider because they will directly impact whether taking benefits early or later is the right strategy for you. Of course, lifetime savings and what you're going to spend your money on affects it as well. Until then, if you have any questions or if there's anything I could do, don't hesitate to text or email me at 516-400-4795 or email us at team@yieldsforyou.com. Until next time, have a great day, and remember, knowledge is power. Don't be afraid to ask the hard questions. Get the information you need to be able to retire with confidence and peace of mind. You only retire once. Get it right the first time.